The next presentation is going to be delivered by Alex. Alex is the CEO at SIA Funds. SIA Funds is a Swiss-based value asset management company. Their target is to achieve returns of 10%, approximately 10% per year for the long term, outperforming benchmarks. I would highlight about SIA two different things. First, their extremely good knowledge about the natural resources market and global markets as a whole, and then also the evolution of their investment policy. I remember 4 or 5 years ago, I first watched a presentation delivered by Alex and Marcos, and I was very impressed by their knowledge and by how well they explain things. And they evolved. Marcos joined the company in 2007, 2008, so it was the best performing fund in the world from 2001 approximately to 2007, and they decided to evolve their investment policy. So they've created 4 categories, and that's worked very well, and we believe it will continue working very well. So 4 categories. Category number 1, global companies that are global leaders in their field, companies like Visa, Coca-Cola, then they expect returns of at least 10% per year. Category number 2, leading companies, which are not as well known as those names that I mentioned, but are leading companies in their fields, companies like Vidrala, Viscofan, and they expect at least 12% per year with those companies. And also cyclical companies is normally between 25-30% of the portfolio. They know a lot about the oil market, the copper market, the uranium market. And the very good thing is that they value each company. And if one company goes up and their expected returns go down, so they would buy a bit more of the company that went down, so very common sense and long term. And category number 4, restructuring companies. And Alex is going to deliver the presentation. And thank you so much, Alex, for joining today.
Thanks a lot, Javier. I can probably save some time on my presentation because he was already describing part of our philosophy. Grüezi miteinander and welcome for the ones that traveled from outside. You find the presentation as well on your seat, on the QR code if you like. We are on purpose Article 6 fund and not 8 or 9, but we are the ones taking care in the sense that we don't want to spend a lot of booklets, printing, etc., etc. And usually when I do such a presentation, I'm almost the only one collecting the stuff after it because I'm a value guy. I want to use it again and again. So I will try to talk a bit about value and net resources to be back on track. I don't want to bore the experts in the room because we have plenty of experts. I've probably, thanks to Javier, I never saw more value experts in Zurich in the same room as today. I think that's quite a unique situation. Just where we are. We are at the end of the lake on this little village called Lachen where I grew up. It's a beautiful place. It's the nicest harbor around the Lake of Zurich. And because I grew up there and I belong to the old families. Also because of low taxes, but that's a side effect. And I like to show the picture of the castle. Unfortunately, it's Rapperswil. But Rapperswil is actually the castle after the guys from Zurich were burning down Altendorf, where my origin comes from, because I'm actually a citizen of Altendorf and belong to that history somehow, because my family used to go back and we were knights at the end, but poor knights. So that's why we became value investors. Now, we manage 2 funds, a value and a net resources fund. And we do that plenty years. And we have a team of 4 investment specialists, or whatever you want to call them, in our investment committee. And every of us have at least 25. I need to improve or increase this figure all the time to see how old we get. And he's the most senior guy. Carlos is getting 70 next year. And 22 years ago, I was able to do an executive MBA program with him, coordinated by the Swiss Banking School. And when I was preparing for the first school block, I was reading his last book called Strategic Logic, and I was thrilled. Thrilled that much that I wanted to convince him to start a fund with me. Carlos was doing his PhD in Harvard more than 40 years ago with Michael Porter, was then the co-writer of Harvard Cases, and I thought really he brings something to the table that is quite unique, because the book tries to explain from where is it possible that some companies can be more profitable than some others, which is the core of competitive analysis. And of course, every fund manager does that, but to a different degree. So I asked him 22 years ago, and then he smiled and told me that I was 4 months too late, as he started with a fund project already at that time. But he said, "Psst, don't mention it to anybody because I'm still formally a professor." So that is an important person. Urs is an interesting character as well. Urs, I was able to bring back from early retirement at 45 for an annual salary of 8,000 Swiss franc, annual salary, because he was very successful in the previous commodity cycle from 2001 to 2011. His fund got, Felix Zulauf Gondwana fund got from 5 million to 1.5 billion. And then they said the story is over, Glencore goes to the stock exchange. If the professionals like Glencore sell at the market for a very nice premium, maybe the commodity cycle is over, and it was. So I was able to bring him back 15 to 16 because our natural resources fund was so close that it was barely at the minimum. And we had to decide either we close it at 5 million or we give it another try. But all of you know in the room that if you're down there in assets under management, maybe there's a chance that the cycle comes back. And that's actually what we try to do. And in the meantime, this fund is now close to 100 million US. Last but not least, the most important person is our Chief Investment Officer, Marcos Hernandez, who actually apologized for not being here. He's extremely busy today. But he's actually joined us, as you mentioned, in 2008, actually, in February, before the thing went south from our fantastic starting story. He's very experienced as an analyst, and he's now basically, since 2019, he's the one leading the portfolio management role. You're not in the wrong presentation, because that's the current pick that is pushed through the village. I used that slide already a couple of times. George knows it already. But I still like it because a lot of investors are just thrilled with the fashion name, etc., etc. And I like to ask people, do you remember your first internet provider? In my case, it was 95, it was CompuServe. There were 150 of those. Not one single one ever made money for the shareholders. So watch out that you're not in a similar situation if you're invest in that space. Now, ChatGTP I use since last week even as a pro with a $20 payment per month, because I saw that there is really some good stuff there. For instance, just before the presentation, I checked how much more electricity you need for a ChatGTP search than a Google search. Because I was listening this week to a lady talking about that subject, and she mentioned 30 to 40 times more. ChatGTP themselves, they said their answer was between 10 to 100 times electricity need for a ChatGTP search. So my conclusion out of this exercise is energy, 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 or electricity, electricity, electricity. The last pick that was pushed through the city was this one, autonomous driving, but not with these pictures. There were autonomous driven car, taxis are now there. Yes, it takes place, but it takes much, much longer. But are they profitable with it? Not sure. But these guys at Rio Tinto, they are profitable. They are saving 190,000 Aussie bucks in the outback in Western Australia, where actually, they can save it. So in other words, maybe you end up making money in AI, robotics, autonomous driving at a space where you will not expect. And that was just a short intro. Now, our value style, like many value styles, focus on similar things. Obviously, everybody tries to buy good business, good management, good balance sheet, and then finally at a good price. Why do we call ourselves, our investment style, strategic value? Because we think it's important to really understand the positioning of a company. Now, a lot of blah, blah, blah. By the way, another interesting note is, I learned yesterday evening from my son, there's a blah, blah, blah index. A bullshit index, where you can put in a text and then it quotes how much, probably it was created by ChatGPT, and then it detects it. So they are very interesting things. But here I think it's important to see that what we try to do, and I like to use these old examples. Some of them, some of you have already heard, but it's important to realize, and I think it's a good occasion to explain what we try to do. Devro is the number 2 in the sausage skin market. There are 3 players in the world, the third being Chinese. So we bought the two others, Viscofon, the Spanish no, and Devro. We detected relatively early. They were bought by a German family. So in the case of value, everybody usually asks us, yeah, but what's the catalyst? Who is going to wake up this name? And maybe you don't need a catalyst from the market. Maybe it's Mr. Private that comes and buys. That was the case for Devro. We bought it at the P of 6 or 7 because it was purely managed. And then they had a CFO first coming from Unilever. He became CEO, and then it happened what it happened. Butzi, a very interesting story. Some colleagues that are here also understood it exactly as we did it. It was trading at price to book of 0.6 first before we bought. That was then last year. And this year it went to 1.1. But 0.6 price to book, debt free, how can that be? It can only be if there are crooks. There are Italians, but there are no crooks. The reason is because of ESG. No large investor in Europe was able to actually buy cement any longer, not realizing that you need 1,300 cubic of cement in the foundation. So you have heard the story probably several times, but we made use of that. Now it's a bit expensive for our taste because for a cyclical, we expect to make 14%. It's now 11 to 12. It's still a fantastic company. And they do a lot of things like carbon capturing and et cetera, et cetera. So it's totally misunderstood. And we think it's about to change the way people approach ESG, and hopefully so, because it's done in the wrong way. Uranium you mentioned, I mean, 6 years ago when we bought it, it was from the devil. Now it's green. It's now neither black nor green, it's gray. But the sentiment is changing. And the last example is just a crazy situation of an oil company in Canada called Cenovus. It's one of the top 3 oil sand companies in Canada. They are now debt-free by now, and they decided to pay now back 100% to the shareholders, the free cash flow, in form of cash buybacks and dividends. And they have even had an investor slide deck last November, a year ago, where they showed that the $75 oil price, I know we are below today, on average they create 33 billion of free cash flow, which was equivalent of the full market cap a year ago. Now the market cap is 39. Now you could say oil will never be there. We have a clear view, and I'm gonna come to that in a minute, that the oil price will rather go up than down. But even inside this market, they will be highly profitable and buy back their shares. That's the long term, 10%. That's that we try to achieve, which is basically good relative to other value guys, with one exception in Switzerland. There is an exception that did 15% since 2008, but we are at 10, and we are happy to have that. If we look at our see-through profitability, as Warren Buffett calls it, we have an average P of 11.5 for the fund with these 4 categories. That's on Bloomberg average, mean average estimates. 3.2% dividend yield and 1.8 time price to book. Now, you mentioned that maybe it could be interesting to have an investment case. We can go through it maybe very, very fast. ISS, I don't know how many of you know the story. Some of you have heard the story already. To me, it's just a sausage skin example in a different way, because I think Ermotti is proud to say that I'm not making more than 40 times the cheapest employee of UBS, because the cheapest employee is not any longer the cleaning lady, neither the cook, because it's outsourced. So the big tendency from the big international multinationals to outsource this not important stuff. And then there's room for these guys. Look how diversified they are. They're everywhere. I mean, the guys that flew in, not when it was dark in the morning, but maybe when you fly out, on the Zurich airport, you see the ISS trucks driving around. And not only here, all over in the world, also in technology, they are 3 out of the top 5 are their clients. They are in hospitals, etc., etc. We own not only one, like in most cases, we like to operationally diversify. So we own Sodexo, a competitor, and Compass Group, which is basically, out of 4, we own 3 of them. The largest position, though, is actually ISS. Operationally, they turned the corner since COVID. They have very nice expectation. Of course, expectation, we know all about what that might be. But look at the share price. The share price is still at COVID or close to COVID low. Why is that? To me, it can only be explained because we are in the finance industry and we think, okay, home office leads to lesser cleaning jobs, lesser kitchen jobs, etc., etc. To me, that's banking space is part of their business, but not the full business, one. Second, there's going to be a fight for talent. So you maybe end up by having table tennis and whatnot in your bank organization or a daycare or a fitness center. Does that needs lesser cleaning or more cleaning? So I think you can give the answer yourself. And a chart that I like to do a lot is the following chart where I show the operational earnings of a company, which are these dark blue lines, and then here the light blue, and then the share price. And you see the share price is massively depressed, rightly so, because basically down here, the earnings were dropping like a stone in 2020. But now the analyst expectations are up here, which is pretty much out of whack. A P of below 8 next year. Historically, a P of 20. Free cash flow yield of 12. They start to buy their shares back, etc., etc. And now this one, I filmed myself with an iPhone in 2019 at the Prague airport, ISS. So they were able to cut their workforce from 510,000 to 310,000. Food waste, they were able to reduce by 30% since 2019. Why? Because if you do the batches in the morning, they know who is in the Credit Suisse building or who was better, and then they cook it accordingly. And I think that's pretty clear. If I may add how I'm untying, maybe 5 minutes on natural resources. That's a chart a lot of you have seen already. That tries to measure the commodity prices, so not commodity companies, but commodity prices as a ratio of the S&P 500. And we are basically at the bottom, close to a 50-year low, or almost at the 50-year low. Now, because it's a ratio, it of course has to do as well with the S&P. So we do not believe that the gap will be only closed from one side, the gap will be closed from the two sides. But we clearly see here this phase where Urs was already once successful. He thinks, and we are convinced that we're going to see a similar development. Maybe if it just goes here, it's a massive magnitude possibility, and that's what we basically are expecting. Now, just because prices are low or in a ratio are low, why should it now change? Commodity markets are long peak cycles. So it's very important to monitor what happens on the supply side. And this chart shows in dark blue line the CapEx, inflation adjusted, that goes into energy. And the light blue line shows the CapEx that goes into mining, industrial mining. And you see it, quite an extreme picture that here since 2014, this has dropped like a stone. And the impact of that will be massive because the last mines that went into production last year or the previous year, being it in Congo from Ivanhoe or being it from Olitoigo by Rio Tinto, they have been financed 14 years ago. So you always have a time lag of 10 to 15 years, which is massive. So now, dark blue line, it's clear, we don't need energy anymore. In 5 years, everybody will drive electric, so forget about it. Yeah, but if that would be the case, we would need to invest in light blue like here. Because I can calculate, if you want, that we do not have enough copper to electrify 10% of the global car fleet. It's not working. Because a global car fleet to electrify 1.4 billion cars would actually mean that you would need 12 million tons of extra copper. And the current copper demand and supply are 24 million, decreasing. Why? Because of that. Because when you have a Volkswagen plant and you produce Volkswagen coming out, it stays more or less. Of course, you have to depreciate the machine and make sure that the oil is there in the machines, but that's it. And mine gets empty every year, 3 to 4%. And that creates this massive cycle when it then turns. We like to invest in commodity companies and not in, because you can also invest in the future directly. That has some issues, and that's why we prefer companies, because the companies are so attractively priced today that you do not even need to bet on a rising price. But of course, if you have a price jump of the underlying commodity, then you get it extra. We do not invest in precious metals because we think there it's difficult. It's very difficult to industrially really produce for 30 years gold or silver. By the way, silver doesn't even exist on itself. It's always a byproduct of something else. And usually when you have to, when you tell your investor, yeah, we just have to go on the ground after 5 years, your costs go X-wise, and that's why it's a total different cost structure. We really like to buy commodity companies that are undersupplied and stay there for a long period. We don't buy exploration companies, and we really want to buy companies that generate free cash flow and give it back to us. Again, that's a picture of the Natural Resources Fund since the COVID low, which is an extreme moment. So we can show basically that we have high beta, also on the way down, obviously. But on the way up, it was very nice for us, and we were able to beat basically the index here in the Natural Resources Index by more than 100%, because this one, it consists mainly out of the large oil companies, and specifically European ones are massively politically managed. Maybe ask ChatGPT next time the turnaround that BP did 3 weeks ago, because until 3 weeks ago they said oil is not going to be needed in 5 years. Now they totally changed and said oil is going to be needed. But they sold all their oil assets to fantastic companies that we own, and they don't have anymore. But they have some wind parks and some other gadgets that work sometime when there is wind. And yeah, I think that's it. Thanks a lot. I hope I was not too boring.